You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, fresh U.S. economic reports and a brighter forecast by shipping giant FedEx fueled investor optimism in this quadruple witching week. Among the news in investor sites, China refraining from raising interest rates despite inflation concerns there. The Fed here saying they will stick with their current policy to support our economy. Better than expected November retail sales numbers, PPI and CPI data that show just a slight uptick in inflation, and a drop of 3,000 in weekly jobless claims. The news was mixed on the housing front, though. While November housing starts rose more than expected, permits for future construction actually declined. But November leading indicators saved the week. They rose 1.1% reportedly, right in line with street expectations. This brings our editor-at-large back in here now, Steve Reitmeister, to give us a little bit of the big picture view of what's going on here with the stock market. Can we actually say with any amount of accuracy that the market's climbing a wall of worry? Yeah.
Well, you know, there was a bit more of a wall that was built up there for a while, especially when the European debt issue started to flame up again with Ireland and things of that nature, and then the news of Spain perhaps being the next one to go creeping up. So the wall got built up, but the economic news in the United States has just been is so solid and improving for such a long period of time that the wall doesn't seem as tall as it used to be. Mm-hmm. And so yeah, I absolutely think that we have the good makings of a fundamental story that should be good for stocks.
So all things on the economic front remaining the same, going into year's end, market can still continue to climb here?
Yeah, the outlook for the economy is better, which is better for earnings, better for stocks. And here again, that little extra piece of that the bond rates are starting to go higher. They're already talking about fund flows coming out of the bond market. So where are folks going to put that money to get an outsized return? They're not going to put it into their money market funds. A lot of that money is going to flow back to the stock market, and I think that's another catalyst for stocks to move higher.
All right, you've been kicking around this investing landscape for a while now.
Yes, I have.
31 years, mm-hmm. All right, total exposure. Share some weekend wisdom with us now on how investors can get some important lessons in investing in turnaround stocks, because I know that's one thing that you kind of specialize in.
Yeah, I mean, right from the outset, when I first started looking at stocks, it was the turnaround story that caught my attention. Why would I just want to buy some boring large cap stock that might go up 10, 20% when, boy, this stock, if business turned around, could go up 100, 200%. And that's the thrill and excitement of the turnaround story. And that's kind of the first reason or the first lesson to be in it is you can really make an outsized return on these stocks that they're at one time that their prospects were looking very dim, and now that they have resurrected, the phoenix has arisen, mm-hmm. and the stock price makes an exceptional move. So that's the first reason to even consider being a turnaround investor. The second thing is, if you're going to do that, if you're going to be interested in turnaround stories, don't jump in too soon. And when I take a look at all my failures over the 31 years of when the turnarounds didn't work out, it's because I jumped in too soon when the stock price was still going down and the prospects for the company were still going down. What I was doing was hoping and praying that it would turn around, okay, and then I would make my gain. Problem is, a company going the wrong direction can stay in that wrong direction for a long period of time. Mm-hmm. What you want is some undeniable proof that things are getting better. And that undeniable proof is not the CEO getting on something like CNBC and telling you how great things are. No. You want to see actual profit on the bottom line kind of information, the kind of information that makes Wall Street analysts stop, pay attention, like, whoa, this thing has turned around, and they increase their estimates for the future. That is the undeniable proof that you need to jump into these turnaround stories and improve your chances for success.
What about looking for growth in value? How important is that?
Yeah, you know, it's funny because in most cases, we've done research that says that growth stocks don't necessarily outperform because sometimes, quite often, the PE is too high when you get into the growth stock and you don't have as much opportunity. But the funny thing is, when you're talking about turnaround stories, getting companies that have higher growth prospects is of value. So let's put it this way. My two greatest turnaround stories of all time are Amazon and Priceline. I bought them in 2001 after the internet bubble burst, and I've ridden them to pretty high gains. I still own some of those shares today. Okay. Now, those were growth stories in the internet space. We all know that if I bought phone companies or a bug exterminator or something boring like that, I wouldn't have had the same big return, because you need something that's going to really have that PE multiple expand. You're going to get that in growth stories. Quickly on the value, just because the price comes down doesn't mean that it's a value stock. So definitely take a look at its value compared to peers. You should be buying that turnaround at a discount.
All right. Quickly for the week ahead, it's a holiday shortened week.
Yeah, GDP final revisions, so another notch higher would be nice, and jobless claims, that continues to be a big story.
All right, there's more still ahead. Stick with us here on Profit from the Pros. Here is your Bull and Bear Stock of the Week. A popular retailer and a steel company make up this week's Bull and Bear of the Week. Our research director Shiraz Mian here with us once again to fill us in on both of them. The retailer is a very recognizable retailer, Limited Brands, LTD, the ticker symbol.
That's right. We have been hitting the retailers quite hard in typically picking them up as the bear of the week. So for a change, we have some positive story here to tell on the retail sector, and Limited Brand is doing an excellent job. There are two core businesses. One is the famous and popular Victoria's Secret outlet, and then is the Bath and Body Works outlet. About 60% of revenue comes from Victoria's Secret, about 25% from Bath and Body Works. And we have a little bit of other businesses too, but these two form the core. Why we have it as the bull? Number one, the management's excellent execution of the plan they shared with the market last year, and number two, a solid results outlook, a very impressive balance sheet, which in fact showed up into a very good one-time dividend and share buyback announcement of the third quarter. Very briefly on the execution that I mentioned, about a year ago, management came out and shared with the market a 3-year plan to take operating margins, the corporate level operating margins, to about 15%. And they've been doing an excellent job on that front. Costs are contained. The comps are as good as anybody's in this segment, and they're doing an excellent job in managing inventories. My sense is that they are close to 2/3 of the way in getting to their target level. So on the whole, a very good story, both on Victoria's Secret and the other businesses, and that's showing up in their results and the estimates that we are seeing on the market. As I mentioned briefly, they had an excellent third quarter results recently. The estimates on the back of that have been steadily going up, and overall a very positive retail story.
All right, AK Steel Holding Corporation, AKS, the ticker symbol. That is the bear of the week. Why?
It seems like all the gods are against them.
The steel gods.
The steel gods. The steel gods and the gods of the end markets. Everything is going against them. It's primarily a domestic steel supplier, and the core end markets for AK Steel are still not as robust and haven't turned around as much as some of the other sectors in the economy. On top of that, the key feedstock for any steel producer, which is raw iron, the prices of that and all the other commodities have been shooting up. So they are squeezed both from the top line due to the continued weakness in the end markets, and also in the margins due to very high costs. And I don't think that trend is reversing anytime soon. So that's the primary reason for our bearish view on AK Steel. They had a weak third quarter. The estimates have been coming down, and I think they'll keep the stock price under pressure for the coming days.
Housing market being a primary market.
The housing market, that's right. That's
okay.
right.
We are going to be screening for stocks again. Stick with us. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week we're screening for short ratio. It's the opposite of tall ratio,
right.
I guess. Kevin Matris is here. He's our top screening guru. He's going to fill us in on exactly what this means. So let's start there. Exactly what does this mean?
Well, the number or the short ratio, I'm still thinking about a tall or a short ratio.
Yes, right.
The short ratio is the number of shares sold short, which are bets that the stock is going to go down, divided by the average daily volume. This is also sometimes referred to as the days to cover ratio because basically tells you how many days it would take the short sellers to cover their positions if good news hits and the stock starts to go up. Long story short,
so to speak.
Long story short, the higher the ratio, generally it is believed that that it's going to take that much more time to cover and a big rally could ensue. So that's the whole premise.
So how is this used?
Well, typically investors are going to look at the short ratio and they're going to want to see a short ratio greater than 8 or 10 days because people believe that that is a difficult number to cover. And again, as we said before, if you do see something happen and an upswing does ensue, those shorts are going to have to really scramble to be able to cover their position, and you could really see a pretty impressive price response.
Quick example, because it almost sounds like a contrarian play.
Yeah, it really is. So when I'm doing it, for example, you know, oftentimes if I'm looking for stocks that are in a lengthy consolidation pattern, I'll pay attention to the short ratio. And the reason why I'll do that is this. When you're looking at a consolidation pattern, that is an area of indecision. So you have guys who are making bullish bets, guys who are making bearish bets, and they're waiting for something to happen. However, if the stock breaks out, the people who are in are probably going to want to add to their position. The people who are on the sidelines are probably going to use that as an opportunity to get long. But all of these guys who had their bearish bets are going to have to, you know, panicky. They're scrambling to get out, and they're going to have to buy their shares back. That can really set up a very dynamic situation. So that's how I prefer to use it.
You can use it when the market goes down as well?
Yeah, you know, it's interesting, too, because if you were to look even a couple of years ago when everybody was worried that the stock market was going to go to zero, or even now, if you're just looking at a stock and it's getting beaten down, a lot of times when everybody's wondering if the bottom is in, you can use the short ratio to try to uncover extremes. Now, on the upside, too, I like looking at it if the stock is going up, or if, let's say, it has crossed a pivot point or has gotten above some important moving averages. At that point, I think that you may see a lot of people piling in, especially institutions. So if institutions pile in, you've got big buyers, a lot of desperate sellers that also can really make the stock power higher.
All right, parameters real quick.
Yeah, we're looking at stocks where the 12-week percentage price change was greater than 20%. We want the current price divided by the 52-week high to be greater than 0.8. In other words, it's within 20% of the 52-week high. Projected growth rate higher than the industry median. Short ratio above 10 days. And I want the current short ratio to be greater than the previous short ratio from last month.
Couple of stocks that came through.
Bunch of stocks came through. Here's 5. Cathay General, Carbo Ceramics, Fred's, Spartan Stores, Texas Industries. They all look very interesting, and they look like they are ready to continue their uptrend or break out.
Diverse set of industries.
Very diverse set of industries, and these are really companies that you're going to want to keep on your radar screen.
Own any?
No, not yet.
And you notice I kept the puns to a minimum.
Right, right.
All that short stuff. We're headed to the round table next. Stick with us. Comments or questions are always welcome at mailbag@zacks.com. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. The Fed and inflation, those are the two main topics on today's agenda here at the Roundtable, and as always, top stock picks of the week, so you'll want to stay tuned for that. Steve Reitmeister, our editor-at-large, joins us once again, as does Shiraz Mian, our research director, and market technician, Kevin Matris. So, The Fed earlier this week, said that they will stick with the course that they've outlined as far as stimulating the economy here is concerned. And I'm trying to still get my head around some of this here, so I need help from all three of you probably. So we got a good bag of economic news out this week, and it's been consistently, positive here over the past few weeks. So if the economy is doing well, as everyone seems to be saying it is, and the stock market poised for double-digit gains in 2011, why isn't the Fed trying to develop an exit strategy, Steve, as far as stimulus is concerned?
What they said all along is that the rate of growth of the economy was perhaps not high enough to be self-generating, that when you start to take away some of the stimulus that was out there, that would perhaps start to falter, that inflation or the low deflation might become deflation, and those were outcomes that were not acceptable. So what they were trying to do is, whatever bullets they had left in the gun, to shoot them in the air as fast as possible, to try and raise economic activity, to try and raise the rate of inflation, so that the economy could get on a pace that it would become self-sustaining and new jobs would be created, which creates higher income, higher spending, and so on. That could kind of cyclical growth that you want to have take place. So that is why the Fed could not back down from their previous positioning of putting that $600 billion into the bond market.
All right, but Shiraz, there's still a few inconsistencies that are taking place right now that I'm still trying to understand. Okay, so help me out here. So QE2 was supposed to drive down bond rates, as I understood it. Instead, they're at 6-month highs.
That's right.
And that happened in the first round as well. Stocks, coincidentally, have also gained, in the aftermath. Kind of an unusual occurrence there, considering that the bond and stock market have inverse relationships to each other.
That's right.
Help me through this. Help me work through this.
There are two camps in the market when they try to answer this question, and a lot of folks are trying to put their heads around this conundrum in a prior Fed's life. They would have put it this way: bond yields are going up, in my view, because the outlook for the economy is steadily improving.
Okay.
And in the face of the Fed spending $600 billion to bring those same rates down, that becomes problematic. But in my view, it's not problematic, because what the Fed is trying to do with that $600 billion purchases is to improve the outlook for the economy, try to reflate the inflation outlook, and in the end improve the employment picture. So with those key areas of the economy on the mend and looking up, folks in the market who invest in the fixed income and in treasuries, they see that the long-term inflation picture is better. Deflation is completely out of the picture, and the double dip fears are completely unfounded. And it's this much improved outlook for the economy which is basically pushing the yields up. So absent the Fed's QE2 program, we may not have seen this improvement in the economy. So it may seem contradictory on the face of it, but in reality they're not.
So Kevin, what do these rising bond rates mean for stocks?
I think the stocks are rising, and I think bonds rose just because that projects future demand. I think the mortgage rates are up a little bit because people believe it is going to stabilize the economy, and I believe stocks are doing the same thing. I believe that this suggests that we're going to see a much stronger economy, and I see both of those things continuing. However, I don't think mortgage rates are going to continue. I think this is kind of a blip. While I don't know if mortgage rates are going to come down that much more, I think at the very least they probably could stabilize in this area, but I don't see a big run on mortgage rates.
All right. So, Steve, all in all, then, as you said at the beginning of the program, market can move higher here, and it probably will move higher.
Yeah. When you take a look, put away all the extraneous noise. People pay for stocks because they are buying shares in those companies to get a stream of earnings. That is what stock ownership's about. Right. The earnings outlook has steadily increased. The third quarter was very clearly a positive quarter, which was led to higher estimates in the future. So long story short, corporate earnings say right now that the stock market could easily be 10 to 15% higher without being overvalued one iota. And if the economy continues to pick up, then the earnings outlook will improve and stocks could go up even higher from there. So I'm looking right now at what should be a fairly good 2011 for stocks.
All right, give us your top stock pick of the week.
I'm going with an ETF that has nothing to do with stocks.
No, okay. Great.
So I am going with the 2X short 20-year bond, which is TBT, and what that is doing is that we were talking about how bond rates are going up. I believe they will continue to go up, not because of any great fear of what's going on or any great inflation expectations, but essentially, if bond rates have been going down for 30 years and everyone's been making money too easily and putting money into bond funds, because you can always make money in bonds, when that reverses and people take a look at their quarterly statements and see that they're losing money in bonds, they will pull money out of the bond fund, that's less buying interest in bonds, and the rates will continue to rise from here. So already made a nice profit in this trade the last couple months, still more to come.
Cool, Shiraz.
An auto parts supplier, AutoLiv, ALV is the ticker. It's about a $7 billion market cap supplier, which specializes in safety features, seat belts, airbags, and things of that type. The outlook is very good for the sector as well as for the company itself. On top of that, they pay a pretty good, decent dividend too, about 1.8 to 2% range.
Okay, Kevin.
Mine is in real estate. CB Richard Ellis, ticker CGB, CBG. They are a global commercial real estate services firm. They offer a wide range of services. Highlights are this. They have a projected growth rate of 49% over the next 12 months. They have a 3.9% positive EPS surprise. Big sales surprise. This is on the move. I think they got a 25% increase over the next little bit.
We have to leave it there. Thank you for being with us this week. We'll see you next time on Profit from the Pros.